Roth IRAs, convert or contribute? That's the question we're going to answer in today's video. Thanks for joining. Is it better to make a $7,000 contribution this year, or is it better to convert $29,167 of pre-tax IRA to Roth IRA, which of course triggers a tax of $7,000 in my assumptions? So then to look at that analysis, I do this through the Decision Center. There's, I think, several different places that you could look at this analysis. And I like the Monte Carlo analysis, which gives us a probability of success for retirement. The base case for Keegan and Taylor, as of right now, they've got a probability of success of 86%. That's their base case. That's not part of the analysis or the comparison that we're doing. In order to look at the comparison, what we want to look at is, let's first start with the Roth contribution. If they make a $7,000 Roth contribution, that moves their probability up. We'll see once this generates. It moves the probability of success from 86%. A lot of calculating going on here. It's taking
a little bit of a drum roll.
Right. Drummer's getting tired at this point.
Yeah, I was gonna say.
Okay, so it moves the needle 1 percentage point in their probability of success, from 86% to 87%. And what I also like to just look at, really, to put some value or to quantify what that difference is looking at the total portfolio assets left at the end of the plan. That's when Keegan and Taylor are 95 years old. Actually, the older or the younger of them hits age 95. At the end of the plan, how much of their portfolio remains? And the Monte Carlo analysis gives us an outlook that really kind of a three-pronged outlook. If the market experience for Keegan and Taylor looking forward is an above average market experience, they may have as much as $18 million left over at the end of the plan. If it's an average market outlook for their remaining lifetime, then they may end up with over $9 million remaining. Or if it's a below average market experience for them for their remaining lifetime, then they end up with $2,869,101. And I think for the purpose of this side-by-side analysis, let's just use the average and say they end up with $9,016,806 at the end of the plan. Okay, and that's if they make a $7,000 one-time Roth IRA contribution. Okay, so now let's take a look at the other side of this comparison. What if instead of making that Roth IRA contribution, if they convert $29,167 of pre-tax IRA into Roth IRA, where does that leave them? Well, we can see just right off the bat, their probability of success goes from the base case of not doing anything, 86%, or the Roth contribution of 7,000 was an 87% probability of success. Now we're at an 89% probability of success by converting the $29,167 and not making a Roth IRA contribution. Instead, we're using that $7,000 to pay the taxes. Okay. And
so Dan, just for a moment, it's $7,000 out of your left pocket into your right pocket in either of these scenarios. That's right. Exactly.
That's exactly right. But look at the average
Yeah,
portfolio value left at the end of the plan now.
almost
Uh,
13.
we're looking at yeah, basically $13 million, 12,977,944. And the number with the 7,000 Roth contribution, that was $9,016,806. So let me calculate that difference. To tell you it's a substantial difference
Yeah.
is an understatement. The difference is $3,961,138 to the better for making a Roth conversion before making the Roth contribution.
Yeah. So let me ask some clarifying points for the viewing audience. Any change in the number of years in which you're measuring this?
I'm not sure if I understand. I mean,
So it's their lifetime. You didn't change from the number of years that this is being calculated, scenario A versus scenario B, correct?
no, they're apples to apples.
Right.
The only change
Right.
is what they do with the 7,000. That's
Yeah.
the only difference.
Rates of return didn't change, right?
Yeah, that's exactly right. The Roth conversion going into the Roth IRA, the $29,167 is assumed to earn the same rate of return as the $7,000 Roth IRA contribution would have earned. And
Yeah.
I'd be happy to toggle over and show those details. So if we open up the Roth conversion, the Roth IRA that's going into, I put that as an aggressive growth rate of return assumption, assuming that the Roth IRA would be the last asset you would use in your retirement years because it's a tax-free asset. And the thought process there is if it's growing tax-free, let it grow tax-free as long as possible. So use this money last.
Yep.
That also informs us and provides us with and some allocation directives that allow us to be more aggressive since we have the longest time horizon. So I used the aggressive growth, which assumes a 9.5% rate of return on that asset. So that's the Roth conversion. And
Yep.
let's just take a look just to be sure we're doing apples to apples comparisons here. If you made instead a $7,000 Roth contribution, same rate of return, aggressive growth, 9.5% is our assumption.
Yeah.
So we
Great.
are
Thanks.
apples to apples, other than what you're doing with that $7,000.
Yeah, it's just simply the difference in the 29,000 compounding at the 9.53 versus the 7,000 compounding at 9.53 over that period of time.
That's exactly right. That's exactly right. So it's pretty powerful.
Pretty powerful. Yeah.
Yeah. And so I guess to the conclusion that, of this, or the summary of this analysis, is that for a person who has done what many in our mainstream financial media suggest that we should all be doing, which is maximize your contributions to your 401k, and what most people in I think the data, as you said earlier, Scott, supports this. When people do that, they're doing it on a pre-tax basis. So when a person has been diligent about saving money into pre-tax 401ks, which ultimately are rolled over to IRAs, or they've contributed to IRAs on a pre-tax basis, deducting those contributions before making new Roth IRA contributions, or before going the direction of a backdoor Roth IRA, which is a hot topic. This analysis strongly supports converting those pre-tax dollars using the same dollars that you would otherwise have used to make that backdoor Roth contribution or a regular Roth contribution. That's the conclusion.
Well, that's terrific. Yeah, that's pretty clear.
Yeah,
Pretty clear.
and I think there are other ways to look at that analysis, but I think looking at probability of retirement success that's a pretty good one.
Yeah, agreed.
So
Agreed. That's great. Thanks, Dan. That's
yeah, definitely. So
really good information.
We threw around some terms. We talked about backdoor Roth. I don't know, maybe you want to take a minute just to explain what a backdoor Roth is versus a regular Roth.
Yep, sure. So your contributory Roth is limited by one's income. So for those high income earners, so for a married couple filing jointly, it's approximately the cutoff for a contributory Roth is 230,000 approximately. We can get into further minutia or the nuances of the 230,000, but let's try to keep this pretty straightforward here. And for a single tax filer, I believe that number is around 135. But you might want to double check me on that, Dan.
Yeah, I'm going to pull this up for us here in just a moment, just to take a look at it.
Fact check me.
Yeah, that's right. I'll let you carry on while I.
Okay. So I'm going to continue using a married couple filing jointly as the main example. So if your income is above that 230,000 threshold, you no longer qualify to contribute to a Roth. But there's, quote unquote, a loophole, a way around this called a backdoor Roth. And Dan and I have written articles. There's articles in Forbes, Kiplinger's that you can find on this topic. Michael Kitsis in our industry, who's kind of a financial personality or influencer, if you will, has written about this several times. And so what you can do is you can make a contribution to a non-deductible IRA. So traditional IRA that's not tax deductible. And then you can convert that contribution immediately, next day, a week later, to a Roth account to get around that. There is no income limit to making a non-deductible contribution. There is no income threshold or limit in which one qualifies. There's also no income limit to converting from a traditional IRA to a Roth IRA. So, but there are a couple catches. And Dan alluded to one of those in the analysis work that he was running through, and it's called the pro rata rule. If you have existing pre-tax IRAs, so not 401ks, let's be very clear about this, they need to be pre-tax IRAs. A SEP IRA would qualify as that, or a traditional IRA or IRA rollover that came from an employer-sponsored plan qualifies, so that if you have pre-tax dollars sitting in an IRA, that needs to be part of your calculation and converting when you convert from the traditional to the Roth. And so it is just a sort of, like I said, it's a loophole or a way around the system. If you don't have any traditional IRAs, so no rollovers from a former employer, no SEP IRAs, then it makes it really clean. You can go straight from the non-deductible IRA, you make your $7,000 contribution, move it over to the Roth or convert it over to the Roth, and there's no tax consequence for doing that. It just gets a little more sticky or a little more complicated when you have existing traditional or pre-tax IRA money. Anything you want to add there, Dan?
No, nothing. Nothing to add to that. I was just searching for the information. The IRS has not yet updated their website, but they have put out this circular. I'll highlight the areas on this. Let's see here. You're seeing my screen now, correct?
Yep, I am seeing your screen. Yes.
Great. Let me, this is a circular from the IRS for the purpose of Roth contributions.
Okay.
We see tax filers filing, married filing jointly. That number is now
30.
218,000 to 230,000 is the phase out there, and that's for married filing jointly. For single, it's 138,000 to 146,000. So making over 146 as a single tax filer phases you out of eligibility for making direct or contributory Roth IRA contributions.
Right. Yeah, thank you. And again, just to reiterate, that's, when we're talking about the backdoor Roth, we are referring to it as a strategy or a tool to utilize for high income earners. So married filing jointly, roughly those people are earning household income 230,000 and above, and an individual tax filer, someone earning, let's call it 145, 146 and above.
Yes.
And so that's who that population it's applicable for.
That's right. So I don't have anything else to add there. Definitely big fan of the Roth IRA and Roth treatment on your investments to be able to grow money on a tax-free basis. The analogy we always use is the farmer with seed. If you were a farmer and had a bag of seed, would you rather pay tax on that bag of seed, or would you rather pay tax on the whole harvest that it creates? And it's not a trick question.
Right.
Most people answer that one correctly and say, I think I'd rather pay tax on my bag of seed. When we consider the national debt, we consider the state of the Social Security system, when we consider other entitlement programs in their financial state today, I don't think there's a real strong argument that taxes are not headed upward in the future. And so there is really the financial basis for making the pretty blanket recommendation that Roth IRAs are an optimal vehicle for retirement savings purposes.